Investors are once again being lulled into a false sense of security regarding inflation and the Fed's apparent success at reducing the rate. This morning, we got the release of the October Producer Price Index. And if you remember, when we got the CPI for October, and that came out lower than expectations, it sparked a huge rally in the stock market. And the same thing happened, at least initially, when we got the release of the producer prices, which also came out below expectations. And when it comes to inflation, lower is better. The consensus estimate was for a 0.5% increase in producer prices over the month, and that would have followed a 0.4% rise in the prior month. But instead, we got an increase of just 0.2%. Not only was that well below what the consensus had forecast, but it was below the low ends of the range of forecasts, which went from a low of 0.3 to a high of 0.5. The year-over-year number also coming in below expectations, as you would expect. The prior month, it was 8.5%. The expectation was for a drop to 8.3, but we dropped all the way down to 8.0, matching the low end of the range. If you strip out food and energy, the so-called core, they were looking for an increase of 0.4, which actually would have been a bit hotter than the 0.3 from the prior month. Instead, we got zero, no increase at all. The way Joe Biden would describe it, no inflation, the end of inflation. The consensus estimate was from an increase of 0.2 to 0.4, so well below the low end of that range. And again, the year-over-year core, which was supposed to be up 7.2, which would have matched the 7.2 from the prior month. Instead, it was only up 6.7%. And if you X out food, energy, and trade services, the rise was just 0.2, half of the 0.4 that was expected. And the year-over-year rate declined to 5.4% from 5.6%. Now, of course, all of these are still strong numbers, with the exception of the food and energy month over month, which was flat. But just looking at the increases, we still have a big inflation problem, even if these numbers seem to indicate that the inflation problem is going away. It's not. But the markets are keying in on this data, and the knee-jerk reaction was an immediate rise in the S&P futures. And in fact, by the time the markets opened for trading, we did have a 450-point rally in the Dow. Now, intraday, the Dow ended up surrendering all of that rally. I think at one point it might have gone down a couple of hundred before closing with a gain of about 56 points. The Nasdaq, though, had a bigger rise. It was up 1.27%. Russell 2000 up 1.5%, and the S&P 500 up almost 0.9%. So most of the index still getting a lift from this supposed progress that is being made on inflation. And again, all of this supposedly is going to give the Fed cover to pivot, if not outright pivot, do the soft pivot that I've been talking about, which is dialing back the degree of hawkishness, how many rate hikes are coming, how large those hikes are going to be, and how long the Fed is going to have to leave those rate hikes in place before it can reverse the process and start going back down. But any apparent progress that the Fed has made in reducing inflation is only temporary. It will not last. One of the ways you know this is by looking at the reaction in the currency market, because while the stock market was rising, the dollar was tanking. At its lows this morning, the dollar index traded all the way down to 105.34. Now remember, 105 is the key level that I've been talking about, and we're almost there. And when the dollar hit that low, that meant the dollar had declined by 8% from its high that it set 8 weeks ago. That is a big decline. And here is the irony of what's going on. The more it looks like the Federal Reserve is making progress on bringing inflation back down, the weaker the U.S. dollar gets. It's the weak U.S. dollar that's going to be instrumental in raising the inflation rate back up. So in other words, the Fed is a victim of its own success, even though it's not real success to the extent that the market perceives that there's success. That is sowing the seeds of failure. One of the main reasons that U.S. inflation hasn't been much higher, other than the fact that we lie about it in the official statistics, has been the relative strength of the dollar. not in absolute sense, because the dollar is obviously losing purchasing power, but in foreign exchange markets, on a relative basis, it has been extremely strong until the last 8 weeks against all the other currencies in the world. And that has helped diminish the impact that inflation has on prices, because as inflation was driving prices up, the relative strength of the dollar was pushing them back down. And so there was an offsetting effect which mitigated the increases. The flip side of that, of course, is that in Europe, it's the opposite effect. The weakness in the euro was exacerbating the increase in consumer prices over there, because not only did they have to deal with the effects of their own inflation, but they had to deal with the reduced value of the euro in relationship to the dollar. But now that the tables have turned and that the dollar is now falling, now we're going to have to get a taste of our own medicine. We're going to start to see this impact our consumer prices, except it's not going to happen right away. There is going to be a bit of a lag, but by some point, maybe early to mid 2023, the weaker dollar is going to start to show up in higher consumer prices. Number one, it's going to immediately increase our import bill, because now we're going to have to pay a lot more to import those products. It's also going to increase the cost of transporting those products to the United States, because a weaker dollar is going to drive up both fuel costs and other shipping rates. And of course, all of this has bad implications for US GDP. Remember, the only reason that we got positive GDP in Q3 was because the trade deficit was a lot smaller than it otherwise would have been. And one of the main reasons for that was the strength of the dollar, which brought down the cost of our imports. Now, of course, we also had the ability to export all that oil from the Strategic Petroleum Reserve. Of course, we're going to exhaust that at some point, and so we're not going to be able to prop up our trade with strategic petroleum reserves. But once the dollar really starts to fall, that process gets reversed when it comes to cheaper imports. We're going to have to be paying through the nose for those imports, and that is going to subtract from GDP. But it's also going to exert more downward pressure on the economy because of the upward pressure on consumer prices. For example, we got earnings news today out of Walmart. Now, Walmart stock actually jumped quite a bit on the day, rising 6.5% because their earnings beat estimates. But what's more important is not what they reported as earnings, but what they reported as being the driving forces behind those earnings. And if you read that report, it paints a pretty bleak picture of what's going on in the U.S. economy. First of all, Walmart is reporting that one of the reasons that it's having higher sales is because more affluent households are now doing their grocery shopping at Walmart. And these are households with incomes over $100,000. Now, why are more affluent households shopping at Walmart? Well, it's because they can't afford to shop at the more expensive, fancier markets that they used to go to, because prices are up so much. In order to put food on their tables, they're having to trade down and buy cheaper stuff at Walmart.